The loan officer training with the mortgage calculator. Today we're going to be talking about title investing conditions. We'll wait just a moment here to go live on all the different platforms, give everybody a chance to tune in. Feel free to drop a comment there in the chat as you tune in. You can also drop questions there in the chat as we go through the presentation here today. I see some comments already coming in. All right. Thank you. Jose, you want to mute yourself? I hear you clicking around and all right. So those that just jumped on, we're just waiting a minute here to get started. Go ahead and drop a comment in the chat. We're going to get into the presentation here in just a moment. But thank you for all tuning in nice and early. Appreciate that. All right. Looks like we are live on all the different platforms, so we can go ahead and get it started here. We'll take the chat off the screen, but keep dropping comments there, drop questions there, and let's go ahead and get into it. So welcome, everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We are a correspondent lender specializing in non-QM loans, and what we do every Tuesday and Wednesday evening at 7 p.m. Eastern Time is the Loan Officer Training Series, where we do a new topic, a new training topic for loan officers. Today, we're going to be talking about title and vesting conditions and just some overall title info in general. So Jose, our sales manager with 28 years of experience as a loan officer and a realtor, deals with title on both sides of things. And so he's going to do a little presentation here and break down some info about title. So I'll go ahead and hand it over to you, Jose.
Good evening, everybody. How are you all doing? Thank you for joining us for tonight's training on clearing loan approval conditions, specifically dealing with title investing. Now, title investing is not like numbers and cents, right? It's even a little bit further out there than last night. At least last night we were talking about property-related conditions. Now we're talking about conditions related to the title of the property and how it is being vested in the owners. So, like yesterday, we believe that being proactive as complete in your documentation up front will definitely help prevent a lot of these conditions. Of utmost importance, I would say, is when you're having entity vesting, right? They're taking title in an LLC or a corporation, and we haven't obtained the necessary docs up front that we need to properly vet the deal, right? Operating agreements, articles, all those other good things. So we'll get into that. So all important, and I like the slide, the photo yesterday, so I used it again today because it is so on point, right? What impacts home loan eligibility? So it's very important because the underwriting of the file again begins with the pre-approval and begins with our assessment of what we're dealing with, right? Yesterday we were talking about our assessment of basically of the collateral, right, of the property in all the different ways. So now we're looking at the collateral. Yesterday's view was looking at appraisal and property related items. Today it's obviously all about the property, but now we're talking about vesting, title vesting. So it's very important to get a little context, right? So what is the difference between title and vesting? Because sometimes these terms are used interchangeably, but they're really not. They work together, right? So title refers to the actual ownership of the property. Who is on title to that property? Real key, right? When you have a purchase or you have a refi, you have to make sure that you have everyone that's on title. And if they're not on title, if somebody's being added to title, what are the seasoning requirements? I'm getting a little bit ahead of myself on this slide. So Title refers to actual ownership of the property, and vesting refers to, and here's the important part, how the owners hold title to the property, which can change the owner's ability to encumber, sell, or will their interest in a property. I'll get into that a little bit more now when we talk about the different vesting, the different ways vesting can be held. So again, a proper assessment of the transaction and the borrowers involved in the transaction will mitigate the risk of title and vesting underwriting conditions that cannot be satisfied. And here's some basic stuff, right? Basic, but you'd be surprised how we miss these basic dotting of I's and crossing our T's, like I was mentioning the entity, right? So, who are the buyers or the owners, and how is it currently vested if it's a refi? Real important because that's going to determine who needs to sign, who needs to be on the loan, right? That's going to determine if you need to disclose to a non-borrowing spouse as well. So these are all conditions that could come to you if not properly addressed up front. So it's really, really basic, but who is currently on title, or who are the buyers, and are they related? If it's husband and wife, or father and son, or just friend and friend, all of that is going to determine how you're going to vest it, or if it's a refi, make sure if it's vested, who has to sign the documents in order to not have an issue when you're trying to close and they're telling you, oh, we're missing buyer A, or we're missing John Doe, who we see who's here on title. And again, what are the relationships of these borrowers, or whether they're buyers or whether it's a refi? What is the intended or current use of the property, right? Because if it's a primary residence, it's going to be different than if it's an investment property, for example, as to who's going to have to sign the documents, right? And obviously, some of this has to be taken into a little bit further, depending on the state you're in. I mean, we're not going to take it that much further because we're not talking about here about community property states, for example. That could be another that could be a title, obviously, title vesting issue. If you're in a community property state and you don't have the spouse, their credit taken into consideration, and all these factors that get really tricky when you're doing community property states. So you definitely want to know what are the relationships of the borrowers. Again, right? Going back to that intended or current use. Is it a purchase or is it a refi? That's a real basic one, but that's going to determine who has to sign. And again, I was mentioning earlier, seasoning on title, right? And this is important if it's a purchase or if it's a refi, because if it's a purchase, not for not for agency loans, but if it's a purchase, for example, non-QM is going to care about seasoning on title by the current owner. They're usually looking at 90 days, 180 days, depending on what the guidelines are. There's going to be a certain requirement, and that may require additional vetting of the asset. And I guess that wouldn't be so much for our title issues, but seasoning on title is one to consider. In real basic, everyone knows, but what is title insurance, right? A form of indemnity that protects lenders and home buyers. It's going to be required for all loans, and it's optional for the owner's title insurance policy. The lender's part insures up to the loan amount, up to the debt. That coverage diminishes as the loan balance decreases. Then you have the owner's title policy that covers the owner from the loan balance up to uh, the insurance amount limit of whatever it was, usually the purchase price. And then importance of title insurance. And here we're looking at the issues that can be covered, right? Fraudulent or forged deed, unpaid taxes. And some of these are conditions that could come up in our title commitment. right? So that's why these covered items, if they uncover an issue as they're doing their title examinations, these will be title conditions for you, right? And obviously, if there's something wrong with the deed that doesn't match up to the current ownership, if you have unpaid delinquent taxes, construction lien, any other unpaid liens, like mechanics liens, incorrectly completed documents. Yeah, the doc's in there, but it was recorded incorrectly. So now you have a cloud on the title. You got to reach out to somebody now to get that document re-signed and re-recorded. You have a prior mortgage not paid off, or at least you don't have a satisfaction on of the mortgage that was recorded, and that's a real bad one, because if that company's now out of business and you can't track down anybody to get a satisfaction of mortgage, you're in trouble. And any unpaid assessments like association monthly assessments, for example, or any other kind of assessment against the property. So, some title insurance policy basics. Now, this is what it's really important that you know what the schedules are, right? Schedule A is your basic cover page that states, what the coverage is, who's being covered, you know, if it's a lender's policy, an owner's policy, and the amount of coverage for each one, who's the current owner, and the proposed insured. And if it's a refi, it's obviously current. The proposed insured is the current insured. Schedule B1, B and B1 includes the requirements that must be met to issue the title policy. Those are your conditions. Those are a lot of really obvious stuff and some not so obvious stuff. Some of the obvious stuff would be like payment of the taxes, possibly of the 2022 taxes or 2023 taxes are due unpaid. In order to avoid, liens, they're gonna have you pay anything that's owed on that property that could be a lien, right? So any type of lien. So you have all your different conditions, the mortgage that needs to be paid off. Maybe there's a document that's needed. Then Schedule B2, just because it says it's the exceptions doesn't mean you don't have to pay attention to it. Because we had one there where the Schedule B2 was talking about a covenant of title, and that covenant of title ended up being for easements and for a proposed association. So we had to go on like this wild goose chase. Not a wild goose chase, it was, but it felt that way to get the necessary document to assure the underwriter that those exceptions had been addressed, because they see that they're like, wait a minute, what is this actually referring to? What's that document? What is what are the details of that covenant document? And when they read the covenant document, it was a 3-page document, and it required getting a party wall or a common wall agreement from an attorney. So that one was like 3 weeks, almost a month, to resolve that one condition that was tucked away real deep in the exceptions on Schedule B2. But the underwriter caught it for sure. So some of these items, these exceptions, are some, mineral and water rights. Those are real basic. The easements, that's where we got stung, because in that easement section, they were talking about declaration of covenants that was covering these easements, and they wanted to know exactly what they were talking about. And that's definitely stirred the hornet's nest. Other exceptions on title could be tax assessments on new construction, because title is issued on a new construction based on the current tax bill, could be $400 a year, right? Actual tax bill could come in at $10,000 a year next year. Title is telling you they're not going to be responsible for the difference. You can't go back to them and tell them, hey, title, wait a minute, there's a problem here because you said it was 400 and it's 14,000, and they're going to tell you, hey, look, but there's an exception there that we don't cover, because that's what exceptions are, things that they don't cover. So let's get a little bit into vesting, right? Actual vesting. So sole ownership, that's an easy one, right? That's a one individual, the only individual holding title. Uh, Tenants by the entireties are for spouses who are currently married, right? This is real important because in tenants by the entirety, the property is not divisible. So if, for example, it's, as you can see there, I mean, it's, if they can't take the property away from one person if it's in both names. So if the one spouse has financial issues, they can't attach it to the property, and that is, I guess you would view that as an asset protection. Now, joint tenancy with right of survivorship is really interesting because in that one, when one spouse dies, the entire interest of that spouse goes to the surviving spouse or surviving joint tenants. Because this is not for spouses only, but normally married couples do joint tenancy with right of survivorship. Tenancy in common, several parties can own the property in whatever percentages they want. This is really important. And upon their death, their interest goes to their estate to be distributed uh, according to their will or to their heirs through probate. So obviously, we don't want it to go to probate, but just to note, if a property is owned by three people and its own tenancy in common, and one of them dies, then you potentially are going to have some additional property owners pretty soon. And then we have our entity vesting, right? In an LLC, a corporation, limited partnership. That's one of our entity vesting is our favorite one here. So, what are some of the common title issues? Because again, talking about title issues is so specific to every deal. I just mentioned an issue that I had on a deal recently where that condition was there in the exceptions, and it made us work really hard. But that's a real odd one. But what are some common title issues that you can have? Well, undisclosed liability, right? Title search gets done, lien search gets done, and all of a sudden you have possibly some additional loans that are there. We mentioned about the payoff, the loan that didn't have a satisfaction of mortgage. So technically, that's a liability that's still there. So I mean, depending what it is, some of the solutions could be as obvious as, well, why don't you just obtain a payoff, obtain a copy of the note, a copy of the mortgage, reach out to the prior loan servicer and get a copy of the satisfaction of mortgage. Hopefully they're still in business. I mean, typically the title company has already gone to the public records and has searched for it, but you can obviously also try searching, or not maybe you, but the whoever's going to search for it, searching the public records, like the clerk of court website that we were discussing yesterday, where all these documents are filed by one of the interested parties' names, right, or by document types. Another common title issue is entity authorization to sign the documents and percentage of ownership of the entity. We get that a lot when one of our borrowers is purchasing a home from an entity, from a property that's held in an LLC, for example, or an S corp, or a C corp, or a limited partnership, which are the four most common entities. And it's a real easy solution there. If they were all this easy, is just to obtain the operating agreement of the entity, which is going to show in there who are the authorized members to sign any docs for the entity and their percentage of ownership as well. In case, depending on what type of entity it is, in case now you realize, hey, wait a minute, I need other people to sign. Either other people to sign as the sellers or possibly other people to sign as the borrower, even if they may not be borrowing, maybe they're still required to sign some of the documents, similar as a non-borrowing spouse is required to sign off on the mortgage, because the mortgage on a loan is the hypothecation agreement. The mortgage is a document that states if the borrower doesn't pay, we can take the house away from you, and that's why they need everybody who's supposed to sign that document. Because if, for example, that non-borrowing spouse does not sign that document, and they should have signed, that's why it's so important. One of my other points I'm going to mention here is uh, marital status discrepancy. We recently had a little snafu on a loan in that. Marital status discrepancy is a big issue because besides it, being fraud or, potential fraud, it could cause serious hardship to a lender who goes to foreclose on a property down the road and finds out that there was a spouse that should have signed. They didn't sign, and they're still on the title. So now, guess what? Now you're stuck. You can't foreclose. So a lot of things to consider there. So again, going back to entity authorization, any liens, right? We get these liens that come up all the time, all different kinds of liens. IRS liens is a real common one that sellers may or may not know they have or may forget to tell us. So
The one
IRS.
that pops up now, SBA liens are popping up all over the place.
Oh yeah, is oh yeah. No, I've actually seen a couple of those. People forget when they're given the SBA cross collateralization
Exactly.
because they don't have enough value in the asset, trying to save on the down payment, right? So SBA says, sure, we'll cross. What do you got? Sort of like the loan shark, right? And they're cross collateralizing stuff, and then they forget. They forget. I had one come up recently, and it was a pretty big one. It wasn't a my personal loan. It was just we had to come up in the office here, and or those hey, they did an agreement with FHA, right, post pandemic, and they forgot that they signed the agreement there where they were putting like $20,000 or $30,000 to the loan, to collect when it gets paid off, but they put that as a second mortgage, with no payment due, but it's a lien for the $20,000 or $30,000, and that you got to get a payoff for that, and all the kind of good stuff. So those are some of those undisclosed liabilities or unknown liens that all of a sudden pop up, and obviously some solutions are easy, obtain payoffs, but it's obtaining the who do you obtain the payoff part from that can be a little tricky on some of these things. Encroachment is another common title issue. That's where like there's a structure that's built on the land, on the subject property land, right? That's not of the subject property, like the neighbors. The most common one would be the neighbor's fence, right? What's going to happen there? Usually, what has to happen is that the neighbor has to move the fence at their cost, so you can close. So some encroachments are not an issue, but some are. Right? It's really up to the investor, and in this case, I'm talking about the the underwriter of the investor. Uh, Easements. Now, when I'm talking about easements here, talking about referring to like the issue I had when they put the easements as an exception, and they reference a document, and what can when that document is referenced, it's usually going to require the issuance of an additional document to clarify the easement, right? And one of the most common ones that is required is a party wall or common wall agreement, right? This is where when you have single family attached residences that do not have an association, you're going to need a common wall agreement to basically specify that they're okay with, sharing the walls and who's responsible for what. Current seller, not the owner on title, that can happen, especially with these flipping deals, that the information that may be recorded on the county website is not yet updated, right? It's usually 3 weeks to a month behind. And depending on what part of the country you're in, it could be even more. So that could, could result in having to obtain a copy of the actual recorded document from the county courthouse, right? Whatever it is, somebody's going to have to make a trip there, get a copy of the document, because public records haven't been updated. In some cases, public records could take 6 months to get updated. So that, but that luckily that's an easy fix, unless they've never recorded it. Then they're going to have to record it and all that good stuff and pay the proper transfer taxes as needed. And then you'll have your clean title. We talked about marital status discrepancy. One way to solve that is a marriage certificate or some other kind of non-marriage affidavit. Keep in mind, fraud guard does also a review if they're married or not. This is touching base on easements, and just if they mention anything like declarations of this restrictive covenants as an exception, because they may have seen a filing and they're saying they put it as an exception because they don't have a copy of it. That's the whole key. Anytime a document is referenced and they don't have a copy of it, they're going to put it as an exception. Like, hey, there's something referenced here in the title examination. I don't know what it is. I don't have a copy of it. I'm not going to cover it. That's an exception. There's a good probability that exception is not going to be accepted by the underwriter. They're going to want clarification, unless there's some clarification on what those documents are, which would entail you having to reach out to whoever you need to reach out to get a copy of those documents. In our case, it was pretty easy. We just had to reach out to the seller of the property that had those documents. So we've already mentioned these resources as we were talking about the issues, but again, we all know there's some basic info out there that's free that we can assess, like all the different municipal websites, clerk of court website, our NETR online website that has access to a bunch of different states and county, all the different municipal type sites, county assessor and all the different ones in there. Data Tree, which is a paid service, you have to sign up for it on your own. Data Tree, if you do use that service, you pay for whatever you request, and then you put in the invoice when closed. County tax assessor's website, we mentioned that. County property appraiser's website. Through NETR Online, though, you're going to have all of these put in one spot for you to click on the different list. If you have any issues with entities, then you just got to reach out for the entity documents. That's why it's so important to get those entity documents as soon as possible, so you can ensure that you have everybody, you're taking into consideration everybody who needs to be taken into consideration as far as signing the loan application and disclosing the loan application. Remember, they could be a non-borrowing entity, but still have to sign some of the disclosure documents, whether it's a trust, whether it's an LLC, a corporation, or an S corp. And that's my last slide.
All right. Don't see any questions. Hopefully everybody watched your other Title One.
Yeah, I was going to say there's some more training there too as well. So you can go back and check that out. Go to our YouTube channel, and there's some trainings on there as well.
Right. The important, I think the most important takeaway from this, right? Because obviously we're talking about title issues are very deal specific. I mean, when you get a title issue, it's like, it's specific to that deal. Like the one that I just recently had, where I had to search for the declaration of covenants, and then we had to figure out the solution and ensure that the common wall agreement would be accepted and allow us to close on the loan. So I would say the most important takeaway from here is when you do get that title commitment and the closing protection letter, review it. Review it, taking into consideration what we discussed here, and avoid a last minute headache, because title review sometimes is something that occurs, or title issues or something that tends to get brought up when the investor is doing a quality control review, prepping the file to close. You're here thinking you're closing in 2 days. I got my clear to close. And all of a sudden, QC says, wait a minute. No, look at this. Underwriter missed it, but I didn't miss it. And now you're thinking you're going to close in 3 days. And now you may be like what happened to me, reaching out for a document that's going to take 3 weeks to get ready, and now you're not going to close. So yeah, basically look at the title commitment, all those, schedule A, schedule B, B1, B2, and see if there's anything that doesn't look right, anything out of the ordinary. And if so, then start throwing up the red flags, the alerts, and reach out to the title. Hey, listen, I noticed this. Did you notice it? Maybe they noticed it already, they just hadn't told you. They usually let you know if there's a glaring issue, but it's good that you reach out as well in case they missed it, to make sure that you're not going to have any issue, because some of the issues they bring up with title may not address all the issues that you may have as a lender, right? On the file, depending on different things like your DSCR loan, and you only have one borrower, and there's 4 owners on the LLC, and you just found that out, and now you need to add 3 borrowers to your loan, right? Different things like that you want to be aware of.
All right. Well, remember, we do this Tuesdays and Wednesdays at 7 p.m. Eastern. So thank you, everybody, for tuning in. Thank you, Jose. Great presentation. We will see everyone next week, 7 p.m. Eastern on Tuesday, for the next episode of the Loan Officer Trading Series. Have a great night, everyone.
Thanks, everybody.